Look at the screen. Tilray Brands, ticker TLRY, sitting around the 475 mark. You've seen the retail forums light up every time there's a flicker of movement, the to-the-moon chants, and the endless speculation about U.S. federal legalization. But while the average trader is staring at their brokerage app waiting for a headline, they are completely missing the structural metamorphosis happening under the hood. Most investors still view Tilray as a pure-play cannabis stock, struggling with regulatory headwinds. That is a dangerous legacy-era misframing. What we are actually looking at is a massive pivot into a diversified consumer packaged goods entity that treats cannabis, alcohol, and wellness not as separate silos, but as a consolidated, data-driven lifestyle platform. The bottleneck isn't legislation. It's the market's inability to price in Tilray's shift toward a high-margin, distribution-heavy beverage model that is slowly insulating the company from the very volatility that keeps retail investors in a perpetual state of stress. Institutional heavyweights aren't looking at the daily cannabis headlines. They are looking at the quarterly revenue stabilization. With fiscal 2026 revenue hitting $915.5 million and the company actively steering toward a $1 billion annual milestone, we are seeing a shift in volume and accumulation patterns. This isn't a meme stock play anymore. It's a slow-burn exercise in operational discipline. When you see those intraday dips, the shaking out isn't a lack of interest, it's a liquidity dance. Large funds are trimming or adding based on EBITDA targets and debt reduction metrics, not Twitter sentiment. While the retail crowd panics over a 4% daily drop, smart money is focused on the fact that net debt has been hammered down to under $1 million. Ask yourself, are you holding for the next legislative pop, or are you waiting for the company to prove its cash flow sustainability? How many of you are still trapped in the legalization or bust mindset, and how many are actually tracking the revenue diversification into the craft beer and distribution sectors? Forget the outdated 2020 narrative where Tilray was just a volatile weed stock. The business model has evolved into a global multi-category juggernaut. They are now the fourth largest craft beer brewer in the United States and hold a dominant share in North American hemp wellness. This is a logistics and brand building story, not just a cultivation story. By integrating operations across Europe, Latin America, and North America, Tilray has built an infrastructure that serves as a gatekeeper in the global wellness space. The legacy view that they are just a marijuana company ignores the fact that their beverage and distribution divisions are now the engines providing the steady, non-cyclical cash flow that the cannabis side currently lacks. They are leveraging their manufacturing capabilities to build a defensive moat that survives even when the regulatory climate remains frozen. The future outlook? It hinges on operational execution. With an adjusted EBITDA guidance in the $68 to $75 million range for fiscal 2027 and a strategic partnership with Carlsberg starting in January 2027, the catalysts are moving away from Washington, D.C. and toward global beverage distribution and CPG innovation. The risks, of course, remain. Continued reliance on equity financing for acquisitions like the BrewDog transaction creates a constant specter of dilution. But here is the takeaway. Looking at the short-term price noise is a trap. The institutional play here is about long-term platform value. If you're waiting for a miracle headline to make you rich overnight, you're missing the actual value creation happening in their supply chain and their pivot toward global lifestyle brands. The real alpha isn't in the next policy shift, it's in watching whether management can maintain this fiscal discipline as they scale into a global diversified titan. Stop trading the news, start analyzing the balance sheet.